So good afternoon, and thank you for joining us for Trade Secrets Your Banker Knows But Seldom Shares, presented by Mike Milan. Mike is versatile and accomplished. He holds an MBA and is VP of Industry Partnerships at Truly Financial. He offers expertise in strategic planning, finance, and sales. He gained his expertise over 20 plus years of diverse professional experience. And in that time, he has developed 13 startups into well-established businesses and earned his nickname Cashflow Mike.
Yeah.
Colleagues know Mike as a personable and energetic executive, one who builds lasting partnerships with managers and customers alike. He strives to apply the full range of his abilities in all that he does. He combines his personal experience with his educational background. He has compiled the perfect collage of information that is crucial for any business owner's success.
Sorry.
Yeah, my name is Gary Dehart. I'm the publisher of Insightful Accountant. I'll be the guy in the background for this session, which is sponsored by Truly Financial. And in short, Truly Financial simply offers a better way for SMBs to bank. I'm sure Mike's going to cover more on that, and that was the best talking points I had for the sponsor. But again, simply offers a better way for SMBs to bank. And so I won't go into any more detail because again, Mike will. Couple of housekeeping items before I turn this over to Mike. CPE is available for the session, but like all sessions, you have to be here for the 50 minutes, 50. You must complete the poll questions. We actually have a combination of poll and keyword, but you have to participate in those. And we will send the certificate, your CPE certificate, to you after the event. It's going to be within 24 hours after the event. Then also, once I go off screen, I will put a link to where the recording will sit, which is on our YouTube channel. But we'll also email that to you. Then I'll also put a link to the presentation deck itself in the chat. I think that's all my housekeeping stuff. Mike, it is all yours. Glad to have you. Oh, and one thing that we didn't mention in your bio is author of 2 books, right?
2 books. That's right.
2 books. And mine literally are in the Amazon mail coming to arrive today.
So you're telling me the check's in the mail?
Check is in the mail. Talk to Amazon about that. So, all right. Well, thanks for sharing with us today, Mike. And I am.
All right. Hey, Gary, I got to tell you what, I don't know if you've ever seen the Dukes of Hazzard, but coming into this webinar today, I felt like the Duke boys sliding across the hood of the car just in time to get in here with the presentation. So, hey, welcome. I'm Cashflow Mike. If you guys don't know me, I'm Mike Milan. I'm I run partnerships over at Truly Financial. And Truly Financial is generally the bank that puts money back into your pocket, right? So that's what we're going to be talking about today is not only Truly Financial, but the trade secrets that a banker knows that seldom shares. And how do I know that? Well, I've been in the banking world now for almost, 15 years. I've taught almost, we'll say 30,000 bankers, accountants, and small business owners on how to do business with each other. And right now at Truly Financial, we're building a digital bank that makes everything a little bit easier for that actual small business owner or the client, the bookkeeper, the accountant, the bookkeeper, and their clients. How do we do that? By being your everyday local and international bank for small businesses. So that's what we're going to be talking about today is what is it about banks? What should you know? If it's ever felt to you like when you talk to a banker, you give them a ton of information. You give them a packet of information, especially if you're looking for a loan. You give them, actual financial statements. You give them everything in the world that they ask for. They take that pile of paperwork and they go into a back room, and like 2 weeks later, they come out and go, no, we can't do what you want. So what we're going to do today is say, okay, well, what is it that they do in that back room? What is it that they're looking at? What are they looking for? And maybe if I know the answers to the banking test, I can either have a better relationship with my bank, or I can actually do better by them and get more rewards, more perks, understand how they evaluate loans, and be a better banking client. So today, let's talk about those obstacles, right? What are the kind of the obstacles that we have as small business owners? And how do I know that? 13 times I've started businesses, And each time, I'm talking each and every time, I've had the exact same experience, right? And it's never changed. So that one of the things I wanted to do, working with Truly Financial, is let's build some things that, that avoid some of the obstacles that I've had as a small business owner. And here were kind of the top 4 that came to my mind. I mean, the first of all is that if you look into your wallet, and I've had people actually argue this with me, right? They're like going, I said, how many banks do you think you do business with? And it kind of starts with the question of how many financial products do you think you have? How many banking products? And the answer is this. The average small business owner has 15 banking products. Yeah. But the average small business owner only has 1.8 products with the same bank. Seems unbelievable, right? First of all, you're trying to think, how do I have 15 banking products? Secondly, you're saying, why is it that there's only 1.8 with any given bank as an average? Well, when you start thinking about it, I've got a mortgage, I've got a car note, I've got a checking, a savings for both personal, and a checking and savings for my business. So you start adding these up, and 15 is an easy number to get to. But any one given bank, and I've did this challenge while training bankers themselves. I say, just open your wallets or your purses right now and pull out a couple different credit cards and see if they're with the same bank. And chances are you have multiple accounts, all with different financial institutions. So why not try to bring things a little bit more closely to home and deal with fewer amounts of people? And I'll explain why that's important. Secondly, that sometimes when we do business online and we give away payments or invoices, things like that, we'll lose, especially on international ones, anywhere from 2 to 5% of our revenue just in exchange fees, especially if you're trying to exchange currencies or you're doing an international wire. There are intermediaries that help along the way, right? From your bank to a local bank in a foreign country or cross-border in a different country. There's people that get involved with that transaction, and each one of them have kind of a little piece of the pie. In some places, you can't go from one currency to another, and it takes a third currency to make that exchange. Like I can think of some nations in Africa. If you wanted to do business in Japan, you would have to go through the US dollar to make that exchange. So from an African currency to the dollar to the yen, and that's how that would work. Or an Asian currency. Lastly, are 2 different things. International banking is really not easy to small business owners, and I thought that wasn't a big deal until I started seeing the stats around how many international transactions do small business owners actually do. And it's around 87% of all businesses out there, small businesses, large businesses included, do some type of international transaction. So I thought to myself, well, how can that be true? Well, then I thought, well, goodness, I just did a project with Fiverr. There was somebody in India I did work with, or Pakistan, or the Philippines. There's all these little transactions that occur all year long that kind of make it an obstacle for me to do business with that person. So that was one of the things I thought was important, because in 2004, I read a book called The World is Flat, and it talked about the globalization of the economy, where we would be able to do business today in our hometowns like San Antonio with anybody else in the world with just a click of the button, through the use of the internet, through the use of computer. And guess what? That happened. What didn't happen yet, what's starting to happen, is banking catching up to that process, right? Banking's still operating the same way we did in the 70s, 80s, 90s. They need to catch up to the 2020s. That's what this process of digital banking, cross-border banking is helping us do, is make any type of interaction, any type of transaction, no matter where you are in the world, easier to do. And then I did say lastly, but I wanted to leave this one for last. That's small companies struggle to compete with large companies because you don't get the perks, you don't get the rewards, you don't get the things that a large bank does, because you don't do the volume of business. So they don't value your business the same way. So that's kind of all the obstacles that I've had kind of growing up as a business owner. But then I looked at it the other way. I said, well, that's probably the obstacles that I have. And I know that at Truly Financial, we're trying to remove those obstacles. But I said, let me put my shoes on, let me put my banker shoes on and look at the small business owner from his point of view. So today, what we're going to talk about is that banker's point of view. How do they view you, and what are the secrets that they have that they don't give to you? And the first one is they've got complaints. I mean, anytime you have customers, you've got things that, you wish were different about the customers. I'm going to tell you what that secret is. What are the things they talk about you so you can be in a better position to work with the bank? Then we're going to talk about like debt and debt structure and how things look in the small business. And we're going to look at cash conversion cycle and why that's important. And I use a concept called the speed of cash because that's the way I want you to think, is how fast does money move in and out of my company? And then lastly, of course, I'm going to introduce you to Truly Financial's bank account, because it really is the bank account that all small business owners should have. And I'm going to explain why. And even if you do 0 international transactions, you do 0, there's still a reason for you to use this account, because nobody else offers what I'm going to show you that they offer. So that's kind of what we're going to go over today. So be prepared for this. Be prepared to learn about Truly Financial's product, and be prepared to learn some concepts that you can put into your client's advisory services plan, or if they're working with a bank, you can make them better prepared to work with a banker going forward. So here's their 4 top complaints. Yeah, people complain about you, and this is what they complain about. First of all, you're not loyal, right? Just like we talked about in the earlier slide, you have maybe 1.8 products of any one given bank. That's why they say you're not loyal, right? Because you're willing to use any old bank's product. Then you don't have enough liquidity. And I don't like to use liquidity because I don't like to use liquidity, solvency, leverage, because a lot of words that people either misuse or don't understand. But when I talk about liquidity, let's just talk about cash. Let's talk about you taking too much out of the business. Then we're going to talk about the timeliness. Sometimes we wait too late to get their attention. Sometimes we wait too late to ask for help. So we're going to talk about timeliness and understanding when you should ask for it rather than waiting till it's past the point that they can help you. And then lastly, your preparation, right? If you look down here, Gary mentioned my book, Don't Be a Dumb Business Owner. That's exactly what they think. Banks think you're dumb. You don't understand my business, right? You don't understand things that are going on in your business, or you don't understand how the bank works either. So dumb doesn't mean unintelligent. It just means you don't understand my business. That's what that means. So we're going to tackle these one by one over the next hour, right? So we're going to tackle them and kind of go through it and explain what it is in a little bit more detail. And then we're also going to show you some ways that you are using Truly Financial can actually help you overcome that. So first of all, Truly Financial is going to encourage loyalty, right? So if you notice that each one of my sections will kind of go like this, I'm going to tell you that this is what they do, and then I'm going to show you how they do it. But before we get there, Gary, can we put up the first polling question? I think I have 2. We're going to have 2 polling questions. We've got 3 keywords. That's how you earn your CPE credit. And this is poll number 1. And so I just kind of want to know, people are willing to switch banks. There's a stat out there that says, that 67% of all business owners right now would be willing to switch banks. And there's various reasons. I kind of want to know what your reason is. So is it that, you don't get rewards the way you like? Is it that, you'd wish they had more built-in services? So you didn't have to use 10 different third-party apps to do the same thing with your bank? Is it that the fees are eating you up? You wish you didn't have to pay as many fees? Did you wish it was easy to operate globally? Or is there another reason? So I'll kind of leave that open for just a couple seconds here. But really what I'm saying is, why does somebody switch a bank? When I was a kid, my dad just never switched bank. He used the same bank my whole life. So I'm wondering, what is it that people do? So here's the results are up right now. Looks like about the winner would be other. So I didn't get other. So put it in chat. If you used other, I'd really like to know why. And Nancy right now says it's because of errors and you apply fees willy-nilly and following their own published protocol. So that's kind of good. That's good information to know, especially, now that I'm working with Truly. I want to know what it is that makes a bank best for you. So if you've got an other, could you help us out and just put it out there in the chat for us? So good. So loyalty. Let's talk about loyalty. And there's a statistic out there right now that talks about you never hear from most of the people that are mad at you. You just never hear. And the stat is you only hear from 3% of the people that actually have a problem. 97% of the people never say anything. So you never even know there's a problem. And some people will go, well, thank goodness I can't deal with the 3% that I got right now. Right. So, but if 3% are only doing it, I had to kind of question that. I'm like going, is that true? And when I was looking at that stat, I visited my grandmother the very next weekend and I saw her go into the bank, right? I went with her because I'm kind of a bank junkie that way, but I saw her go into the bank and she walked right by a guy that was sitting at a desk. He didn't look up. He didn't wave. He didn't say anything to her. She just looked at him and her eyes were fixed right on him. So I looked at him and he was busy. He was just doing his job. She went up to the teller, did her business, and walked out. Never said hi to the guy, bye, anything like that, just walked out. When we walked out, she goes, did you see that Jim and what he did to me? I'm like going, yeah, he didn't do anything. He was busy. He was doing something. Why didn't you say hi? He goes, he should know who I am. He purposely didn't say hi to me. All right. So that's all it was just saying hi. All she wanted to do was be acknowledged. But she never told Jim that. She just went about her business. And just like a casual interaction that you and I would have had, it would have been fine. But here's what happened next, right? It's such a small slight. But what happened next is she told her neighbor, she told the bridge club. It wasn't a bridge club, it's some other like bunko. Some other party that she went to that night. She told my mom. She told, she told my kids even about it. She goes, I can't believe he did that. He just snubbed me. So because of that one interaction, she told everybody in the world. So that 3% that tells you have to be grateful for. That 97% could be just like my grandmother, who's not going to tell you about the problem, but she's going to tell everybody else in the world. So that's one of the things that we try to do over at Truly. And the philosophy that I like to use is let's solve a problem with the first contact. And this comes from the Nordstrom business model, right? And Nordstrom has a business model that uses a graph similar to this. And it talks about, the relationship and the degree, how close they feel to the customer and how happy or satisfied the customer is. And the graph is really simple. It's the most simple graph in the world. It's this. It's saying, the better relationship that we have, the happier you are, the more satisfied you are, because you're not griping. That's a happiness factor where I'm very low in my happiness or very high in my happiness because of the relationship. So let's just change that to gripe factor. How likely am I to complain? So I'm more likely to complain when we have a terrible relationship. I'm less likely to complain when our relationship is good. Well, here's how Nordstrom does it. They're timely. They really, this happened to me. We had a dress that we couldn't find, that they searched all over the city, found it, delivered it to the house within a day. It was timely. It was personal because the person that my wife worked with, they found the dress, they drove the dress, and it was effective because it's exactly what she wanted and she needed. So solving a problem. So if I've now taken this into my personal relationships, whereas everything I do, right, is just, if there's a problem there, I want to kind of solve it with the first contact. Let's kind of move past it, find a way to do it and address it. But 3 things: timely, personal, and effective. That's the way you have great customer service with your clients. So the other thing is you build a better product. If I want to encourage loyalty, if you notice up here at the top, I'm kind of sticking on a topic. That's a complaint. You're not loyal. So what banks try to do is a couple of things. One is solve a problem with the first contact. The second would be build a better product, build things that you can need or you can use. So right now in this space, Truly Financial tends to get compared to a lot of different companies like Relay or like Mercury or Brex or Ramp. You've probably seen these. They do a lot of advertisements on Facebook. Great companies, got a lot of stuff going on. Then you got another one at the top end that does more international stuff like Jeeves. And this is kind of how it stacks up, right? Checking, debit cards, ACH or wire. Can you do those with those? Can you do international payments? And I think I think one of them might have added international payments recently, but this is how Truly stacks up, right, with it as well. So all of those things are built in. What we've looked at is what are the holes? What are the gaps? And Truly wanted to become an all-in-one because it's tough because when I have we'll say a U.S. bank account or Wells Fargo or Capital One, any of those things, then I have to add a Bill.com. Then I have to have a Divvy or a Melio or any of these other ones. What we said was, why? Why should I have to add all these type of services into a bank account? Let's put them all in one. That way it's already integrated and already put in a place where it's easy to use. I don't have to keep adding services. It's already there as part of the bank account. So better products is another way that banks are trying to get your loyalty. So the other thing is better technology. If you've had a bank, and I tell you what, USAA is my bank, and they've been my bank since the 1900s. And I tell my daughter, say, well, back in 1988, I don't know why I say it like that way, but it's funny to me. They don't like it, but it's funny to me. I don't know that there's been much improvement in the platform, right? I think my experience either online or on the desktop has been kind of static over the last years. And when I compare USAA, my personal bank right now that I've had from being in the military a long time ago to the business bank account that I have with Truly, there's a world of difference in technology, look, feel, interaction, user experience. So building better technology is another way that banks are trying to get your attention and get your loyalty by working in ways that we're already used to, right? By working in ways that we're already used to. So that's another way that they're trying to get your loyalty. So how about, let's go to the next one, right? Go to the next one, we'll go right into liquidity. And liquidity means kind of the speed of cash when we convert our assets. So if you look at your balance sheet, this is the way I kind of describe liquidity to friends of mine or small business owners that don't understand liquidity quite well. I say, just look at your balance sheet, and the top half of it is your assets. When people say liquidity, they're talking about how fast can you convert anything that's on the top half of that balance sheet into cash. And I'm talking about your buildings. I'm talking about your inventory, your accounts receivable. How fast can we make that cash? So the analogy that I use with them is, let's talk about water being liquid, right? And there's states of water. And the states of water are pretty simple to understand, especially if you live in the north. Everybody knows ice, water when it's frozen becomes ice, but there's a middle state as well, and it's slush. It's like when ice starts to melt, there's a little bit of ice and there's a little bit of water. So it's kind of a middle state. So then I say, okay, well, water is cash. That's what we want things to be. We want, how fast can we make our stuff, which is the assets, into cash or water? Well, then I show them the current asset list. And usually there's inventory or there's accounts receivable. Those can become cash pretty fast. So I call that the slush, right? It takes just a little bit of time, but not too much time to collect on your receivables or to sell your inventory. So I call that slush, and slush can become water. The last part is your equipment, your real estate, your trucks, those type of things. I call that ice. So water, slush, and ice is how I explain when we're talking about liquidity, how fast can things become assets? And it helps people understand what we're talking about. It's the speed of conversion of assets. All right, here's your first keyword. So if you're out there in the world and you're looking for CPE, here's your first keyword. And the keyword choice, if you put that up for Gary's running the polls and quizzes, what is the first keyword? Okay, so when we talk about liquidity, we're talking about, I want to increase cash in your business. And Truly does that a few different ways, right? It has these smart link accounts. So when you're thinking about like Divvy or other places where I can issue out a spend management card and expense card to my employees, where I can also control the amount of money they spend per transaction, per category, per month. All of that gets wrapped in where I can give them not only the resources they need, but I can also control it and see it happening in real time. I'm not surprised by a credit card statement a month later, like, oh, wait a minute, why did you buy this? And I find out about it a month too late. I know it and can control it sooner. The other thing is like low or no transaction fees. If you haven't been to the pricing page, trulyfinancial.com, go there, 2 different accounts. If you're a person that does a lot of wire fees or a lot of ACHs, there's a product for you, right? So if this is part of your business model, the way that you collect money, send and receive payments, check that out. And then here's the reason. Remember I said, even if you don't do any international transactions, there's a reason for you to get a Truly bank account. And it's the cashback rewards on all purchases made with corporate cards. So when you get a Truly financial account, you're going to get what's called a corporate card, not a debit card, right? And here's the distinct difference. If you go right now to Walmart with your debit card and buy something, you're buying it at 100% of the of what it costs, the purchase price. You're buying it at 100%. Yeah, using your own money, you're going to spend 100% of your own money. If you use a Truly financial corporate card, you're going to get up to 2.5% back on every purchase. Yeah, even the Walmart purchase, even those subscriptions for other, software services, even your AWS or your Facebook ads, all of that stuff, you get up to 2.5% back on every purchase. It's like getting a discount on every single thing you buy when you use your own money, and you're not using credit. So you're not accumulating debt. You're actually just using your own money and taking a discount on everything you buy. That's cash back in your business. That's what we're talking about. We're putting money back into you. And then the last one here is focus on the speed of cash. How fast does money come in versus money going out? Other banks, the reason why you get better perks is because you have a higher average daily cash balance. If you look at it, that's why they put it on the statements. That's how they rank you as customers. Well, they have an average daily cash balance is higher. That means we have more of their money in our accounts all the time. That's not what we're using to evaluate you at Truly Financial. It's, hey, the speed of cash. We want you to use the product and use it to get the cash back rewards, right? Because that's what we're supposed to do, is help you, not keep your money in the bank. We're helping you run your business. So that's liquidity. But here's another thing about liquidity, right? So this is debt to equity ratio. And most people don't get it. They're like, going, debt to equity ratio. Mike, we're talking about banking. We're talking about credit cards and all that. But this is another way that banks will look at you. This is one of the secrets, right? If you're going to take anything from this, the next few things I tell you about math and concepts, you have to put in your pocket. This is an answer to a banking test. And it has to do with this ratio, believe it or not, debt to equity. And I didn't believe it at first either, but it used to be when you started a business. When you started a business, you needed 3 people on your team to kind of help you out. One was an accountant, the other was a lawyer, the last one was a banker. Those were 3 people that were on the pedestal with the business owner, and they were giving you advice, and you were helping run your business just with their advice. Here's what I didn't realize till later on, that 2 of the people that I trusted the most, the banker and the accountant, because you can't trust a lawyer, but 2 of the people that I trusted the most gave me great advice, but it was never the right advice at the right time. They would give me opposite advice all the time. One person would tell me to do one thing, the other person would tell me to do just the opposite, and I could never figure out who to listen to until I realized that what they were telling me actually was the result of this equation, debt to equity, right? And it sounds like a weird deal. And there's a Q&A here. So it's Truly just for businesses. Yeah, Ivan, Truly is just for businesses right now. But we do have, if you're a freelancer, things like that, it's just for business. It's a business bank account. Okay, so, but debt to equity, I'm going to say this. I'm going to back that up because I don't want to confuse you with buying a house real quick. But I have to get there. There we go. But it's total liabilities divided by total equity. This is how bankers measure whether or not you, as the business owner, believe in your company. Think about that for a second. Do you even believe in it enough to put your own money into the company? That's what the equity means, right? You got to remember that net profit gets taken off the income statement at the end of the month, quarter, year, whenever your accountant does that, and put into the balance sheet in the form of retained earnings, which is your equity. So when you have losses, when you take out too much in expenses, when you take too much in distributions, you're also reducing the equity. Let me show you what that means. And they're going to say, if you're not willing to put your own money into this, why should we? Why should we invest in your company if you don't? So here's how to get past that question. So first of all, let's talk about debt to equity, and I'm going to compare it to buying a house. If you bought a house, then you kind of get this a little bit easier, get this faster. But when you buy a house, the bank typically wants you to put down 20%, right? And that means they'll put in 80%. So that's kind of what that is. They put in 20%, you put in 80%. That Q&A kind of freaks me out. So if I go 80 divided by 20, that means 4. Yay, I get a 4. My debt to equity is a 4. What does that mean? Well, nothing, right? What it means is for every dollar I put into the house, I let the bank put in 4. So they put in $4 for every dollar I put in. It's kind of a matching thing. What we know about debt to equity is the higher the number, also the higher the risk. The higher the number, the higher the risk. So if I put in less money, we'll say 10%, and that means the bank will put in 90%. That means 90 divided by 10 equals 9. 9's a higher number, 9's higher risk. So I'm using that as the bank has more risk. So the higher the number, the higher to the investor or the lender, whoever's going to give you the debt. All right, that's what that means. So what should it be in a business? Because they won't give you $9. They won't give you $4 for every dollar you have in the business, but they will give you $2.50 or less. So if I'm looking at this equation, how much do I owe divided by how much do I own, my equity, I'm looking for that number to be 2.5 or less, but not all the time. Because here's the thing, you got to look at the motivation of each person. What's the motivation of the bank? They want to sell you a loan. They want to get interest payments on your loan. That's how they make money. What's the motivation of the accountant? They want to help you pay less tax. So they're going to have lower amounts of equity, lower amounts of profit. So that means you have lower amounts of equity compared to your debt. You could have a higher debt to equity ratio. So both of them have a different motive for telling you either keep money in the company or take money out of the company. It's up to you as a business owner to know when each person is right. And here's how to make that distinction. If you think you're going to need a loan next year, if you think you might need one, then start looking at this number today, 12 months before, because they're going to look at the history, the trend of how you run your company. Looking at this month about 12 months out and trying to move that number down to 2.5 or less. That means the bank put in $2.50 to every dollar you have in equity. If you don't need a loan, if you don't care about loans, if loans aren't even in your radar in the future, by all means, do what the accountant says and pay less tax. But you can't do both. You can't strip the equity out of the company and expect to get a loan. It's just not going to happen. So if you got to know where the threshold is, I'm good on one side, not good on the other. 2.5 is the number you want to have, 2.5 or less. Questions on that? You can type them in the question and answer. I think I figured that thing out now. All right. How about timeliness, right? We talked about timeliness as knowing when I'm going to get in trouble, right? Knowing when I'm going to get in trouble. So Truly Financial also enhances your ability to improve your timeliness, because here's what they're doing. If any of you use just personal payment programs now, we'll talk Venmo or Zelle or PayPal or those type of things. It's super easy, right? I'm on PayPal, you're on PayPal. I can give you money back and forth and it works out super easy. That's exactly the product that's built into a Truly banking account, right? You're on Truly, I'm on Truly. We can swap money and it's almost instant on how you get that money from me to you, just like it would be on Venmo, just like it would be on PayPal. So that exchange is powerful, because what's happening is that the customers that we have that's improving timeliness, and we're talking about the speed of money moving through a company, founders or company owners that are coming in, they're now adding their other companies, right? with me, I had 5 companies at one time. I had a hotel staffing company, 3 bar restaurants, and a property management company. I ran those all as J&M Investments, but all of them had separate bank accounts. But there were transactions that I had between the 5. So it would have been easier to have a Truly account to do that. But here's the one, even if you don't have multiple companies, here's the one that should help you out the most. Working with your suppliers, your customers. Say, hey, if you got Truly, I can just pop the money over to you real quick. And the money just moves between you guys without fees, without delays. You get the money Truly to Truly account. So that's another way you can improve timeliness and improve the speed of collecting money, not waiting for a check, not waiting for a 2-week wire transfer to happen. It happens more or less instantly or within a day or two. All right, so improving the speed of cash. So here's what I'm going to do. I'm going to talk about cash conversion cycles for 2 different types of companies. And this is another one of those concepts. Just like debt to equity, this is another concept that helps you understand speed of cash a little bit better. So I'm going to use these numbers. If you screenshot it, write them down, or it's in the slide deck that's in the chat. Those are the numbers I'm going to use. But I'm going to show you how to use them. If you notice, so right off the balance sheet or the income statement, what was sales, what was assets, what was cost of goods sold. These are all things that you're used to working with. So the first one is we're going to compare what we have versus what we need. All right, what we have versus what we need. All right, so Valerie says, so if your customers are individuals and not businesses, then they can't use Truly, correct? That is correct. If they don't have a business, if they're not a freelancer, if they're just like Joe that works for the Ford manufacturing plant down the road and you are his tax accountant, chances are no, Truly is not going to work for him. Hope that works. But if Joe works at the Ford manufacturing plant and then on the weekends he has a woodworking shop and he's selling wood products out of his garage as a side hustle, well then Truly might be a good product for him for his side hustle business, so he can keep personal and business separate. Okay, so the question we're going to answer here is, how much money should a company have? Because everybody goes, well, how much cash should you have? Well, and we call the cash that we have or have access to our working capital, right? And usually when you have a positive amount of money, that's called a cushion. I've got a cushion. That means my business pays for itself. That's what working capital means. My business pays for itself. But occasionally you don't know how much you should have, right? I know how much I have, but I don't know how much I should have. So in this case, you've got, current assets minus current liabilities equal your working capital. So what's kind of interesting about that is, there are other things like your current ratio, that's current assets divided by current liabilities, which kind of gives you a ratio of how much money you would have, we'll say, in your checking account versus how much money you have on a credit card. That's kind of how that does. It's a comparison, a ratio. In this case, that's what it means, current ratio, right? How much you have. But here's how I explain the ratio. I like to express things in dollars because people don't get ratios as easily. But in this case, if you see a current ratio, you want that to be at 2.0 or higher. That's kind of your goal. Just like I gave you, debt to equity is 2.5 or lower. The current ratio should be 2.0 or higher. And what that means is for every dollar you have or owe on a credit card, you've got $2 in checking to pay for it. And that's kind of how I explain it to regular folks that don't understand the current ratio. Is I give them examples of what things are, like a current asset, your checking account, and your current liability would be a credit card. So the number 1.35 means for every dollar you owe on the credit card, you've got $1.35 to pay for it in checking. And when I explain it to that, to my clients, they tend to get it a little bit easier and a little bit faster. But all we're doing with this calculation is saying this is how much money our company has access to. Now, why this is important, because if you've ever felt clunky in your business, if it's ever like going, oh, I just need somebody to pay me, or I can't pay that invoice till next week when something else happens. If it's felt clunky where you just felt like you didn't have enough money, and if you just had a little bit more, the company would run smoother. This is how much money you have currently, but what I'm going to teach you is how much money you should have so it doesn't feel clunky, right? So that's kind of the cool part of this next section is how much should I have so it doesn't feel clunky. And The reason it feels clunky is because there's a notion out there that's called the financial gap, or some people call it the cash gap. And the cash gap is the amount of time that a business doesn't have enough money to run smoothly. Meaning, I'm waiting for money to come in, but I've already paid everything out. So I don't have any money left, right? I've already used all my money to pay the bills. And if you have inventory, it uses three numbers, and it's a real simple calculation to figure out what your financial gap is. And just like any gap, if you go to London, you see the sign that says mind the gap. They're talking about the subway. You want the gap to be small. Think about it. I mean, what type of gap you want to have to jump over if your life depended on it? A large gap or a small gap? Well, we want it to be a small gap. That's the same thing here. I want that gap to be small. Here's the calculation. It's inventory days plus AR days minus AP days, right? And I'm going to explain why. Because generally, when you start, you get some inventory, right? And it sits on the shelf, and it sits on the shelf for a certain amount of time before somebody buys it. And in this case, when we use the numbers off to the left-hand side, this company's inventory sits on the shelf for 90 days. Well, then somebody buys it. And when somebody buys it, you give them an invoice, right? And that invoice goes home to the business owner's office, whoever bought this. That invoice might sit on their desk for a certain amount of days, right? In this case, using the sample company's numbers, it's 34 days. So the inventory sat on the shelf for 90 days, and then the invoice sat on somebody's desk for 34 days. That's how long we waited for money before it got back to us. We had inventory sitting on the shelf and waited for an invoice to be paid. But while we were waiting, we had to pay for the inventory, right? So, and that's what happens with AP, is that we waited and paid our bills within 56 days, right? So inventory sat for 90, invoice sat for 34. Our invoices sat on our desk for 56 days before we paid them, because by stretching payables, we make the gap a little bit smaller, because that's what we're really trying to do is these two lines, the top and the bottom, we want the difference between the two to be as small as possible. So stretching payables is one way to do it, or shortening your AR days, collecting faster, or shortening the amount of inventory that you have, or inventory days, also makes that gap smaller. Start thinking about how those two lines work together. So in our example, inventory days plus AR days minus AP days equals 68. So 90 plus 34 minus 56. So yay, I got a 68. You're like going, Mike, what do I do with that? Yeah, it's 68 days. I get it. Well, 68 days is the amount of time that you don't have enough money, and it feels clunky. The thing is, this is a rolling number. So it always feels clunky because it's not enough time or not enough money to cover that amount of time. So the next step, we know how much we have, 530,000 from the previous slide. The next step is to calculate how much money we need, right? And we're going to use that calculation, financial gap days. So keyword number 2, and we are cranking down through this, is unlimited. Keyword number 2 is unlimited. Okay. So the last thing we're going to do here is calculate up how much money that we need, right? How much do we need? And we're going to start with how much we have. Our working capital calculation is 530,000. But when I did the how much do I need? How much do I need? I need 916,000. You're like, what? How do you figure that out? Just using those numbers we had. Well, here's how I did it. I take my cost of goods sold. Remember, I had inventory, and inventory, when you sell it, becomes cost of goods sold, right? It's an asset, gets converted to an expense. So cost of goods sold was 4.9 million. I'm going to take that and say, okay, well, that's what it is for the whole year. If I divide it by 365, that gives me the average amount of inventory I buy per day, right? I just peanut buttered my 4.9 million across the whole year. That means on average, I spend $13,000 a day just to buy my inventory. Then that means, well, if that's true, I still have to buy inventory for the days that are my gap. I'm going to multiply it by my gap days. So 13,000 times my gap days equals 916,000. So if I don't want this company to run clunky, where it feels like I never have enough money, I need $916,000. Thing is, I've got 530. So I'm really only short $386,000. So what do I do with that? When I go to the bank and I ask for a line of credit, that's the amount that I use. Instead of walking in and say, Mr. Banker, I need a loan. And he goes, well, how much do you need? And you go, I don't know how much you give me. This is what we're talking about. I can now ask for $400,000 because I can tell a story. Inventory sits on my shelf for 90 days. I pay my bills in 34. I get paid in about 56. Based on that, I've got 68 gap days. And I need to cover $13,000 a day, which means I need $900,000. I've already got 500, so I need 400 to cover the difference. That's how the banker's going to calculate it up. You can look that much more ahead of the game and understand your own business by doing the same calculation. All right. So how do I change it? How do I make it better? Well, kind of easy this way. What if I reduced inventory? I probably can't collect faster than 34 days. I probably shouldn't pay slower than 56. So that's why I chose reduced inventory. What if I just reduced inventory down to 60 days, right? Kept AR the same, kept AP the same. I just ran the inventory down. First of all, I'd have an increase in cash because I'm not taking cash out of the company and putting it back into the inventory. I'm keeping it in my bank account. But 60 plus 34 plus 50 or minus 56 equals my gap is now 38 days. Do you see by having less inventory, I actually shorten the gap. I'm not replacing it, taking money out of my pocket to replace inventory all the time. It sits in the company longer. If I take the same calculation that we just did, I don't need 916,000 anymore. I actually only need 512. You're like, oh, Mike, how'd you do that? Well, same calculation, 4.9 million divided by 365 equals $13,000 a day. I'm just multiplying it by 38 days, which means I now need 512. So this company doesn't need a loan, right? Because it doesn't have a shortage of 400,000. It doesn't have a shortage at all. It has access to 530 and I only need 512. Why do I need 512? Because I'm not buying as much inventory. That money stays in the company. All right, next one here is how is this different for a service business, right? I know about inventory, but my service companies don't have inventory. What do I do next? You do kind of have inventory. You got an inventory of hours, people's time. We call it payroll, right? So you might have customers that you still give an invoice to. You're still waiting for their payment. But meantime, you have payroll periods. And what you do is you take my AR collection period. In this case, it's 45 days. How many times do I have to make payroll in that amount of AR time, AR collection period time? Let's pretend that you pay every 2 weeks. So every 14 days, you have to make payroll. In this sample company, it's $100,000 every 14 days. Well, in 45 days, I'm going to do that 3 times. That means I need $300,000. That's how you do it for a service company. A little bit easier, a little bit different, but that's how you come up with how much money do I need to make sure that I can still keep the company running smoothly. So cool. Then lastly, we're talking about preparation, right? So we went over loyalty, we went over timeliness, we went over liquidity. Now it's preparation. And Truly Financial can help you with that as well. First of all, it is the everyday international banking business, or a business bank, which means we've got the tools to help you already do these things. They're already in place. You don't have to get a bank account and add a Divvy account. You don't have to get a bank account and add a Melio or a Ramp or anything like that. It's already built in at one. So you're already prepared from day one to do these things. We also have the ability to help you in any, our 33 different countries, right? So we can do euros or pounds or Canadian dollars. We've got corporate cards you can issue to anybody, and we can pay now in 65 countries, right? So we can pay in 65 different countries. So here's the polling question number 2, all right? Polling question number 2, and then we'll drive this thing home. How interested would you be to learn more about how Truly Financial can help a business, right? And I'm more than happy to get online, offline with any of you and just kind of explain and kind of show you the demo and look at the Truly Financial bank account. So I'd like to learn more about one of the three things. You can say, no, I'm fine with not saving any money on any transactions. I love paying full freight for everything. So any one of those. Of course, I'm playing with you. I'm messing with you. But if you'd like to learn more, I mean, I'd be happy to help you with that. So if you'd like to be interested in learn more about any of those type of things, or maybe you have a different question, that's fine too. So let's talk about, I talked about debt earlier, and what I've noticed in a lot of these, and I kind of added this in, is that a lot of people don't understand how debt should be structured in a small business. Now, we're not getting into mezzanine financing and all kinds of stuff like that. We're just talking a basic small business. And I'm going to use a beer distributor as an example, right? Like if you drive up to a beer distributorship, here's kind of what you see. You see a building, you see trucks, you see forklifts, you see stuff, right? It's their furniture, fixtures, and equipment, or property, plant, and equipment. It's their gross fixed assets. Well, here's how you buy gross fixed assets. First of all, if you don't use cash and you use a loan, you want to use a term loan. And here's the rule on using a term loan for stuff, is that the length of the loan should match the life of the asset. So if you can depreciate something for 5 to 7 years, you buy that with a 5 to 7 year term loan. If you're buying a house and it's got a 29-year useful life, you should finance that with a 29-year term loan. Why? Because if you match them up, you get a really great advantage. First of all, you get depreciation during the useful life. And as soon as you pay it off, the depreciation ends and it's a good time to either replace or upgrade. But where does the money come from? When a banker looks at your financial statements, he's going to be looking at one place for, can you make the loan payment? He's going to be looking at retained earnings and or net profit, right? And a lot of times they're going to be looking at EBITDA. EBITDA is kind of the big word for cash flow in the banking world. So that's kind of the first level. It's stuff we can see, touch, feel. The second level is a little bit most people miss. But if you go into we'll say a grocery store or a convenience store, they always have all the shelves. And we'll look at the beer shelves right now. They're always nicely faced. They look great. There's a product in every spot, not a lot of open spots around because they keep them kind of stocked. Well, that's what's called base level or permanent working capital or inventory. And what that means is they know about how much they sell every week, so they keep that much on hand. Right. So they know that I typically sell 10 cases of Budweiser. I want to keep 10 cases of Budweiser. And that's how I do it. Well, if you do this step right, and if you've already messed it up, don't worry about it. I'll show you how to fix it. But if you do this step right, you will only ever have to buy your inventory one time. After that, your customers are buying your inventory on a rolling basis. So let's pretend that we need 20 units most weeks. If I buy that the first week, the first time I open a business, I should get that with a term loan, right? A 5 to 7 year term loan, and then I'll pay that off in 5 to 7 years. And you're like, well, I can't get a term loan for inventory. Yes, believe it or not, the SBA does lend money on inventory. So there's a way to get that financed for your first amount of inventory. Then after that, we already know that you're going to pay with net profit. You pay term loans with net profit. But when you start to sell those, right, people come in and maybe they buy 10 cases, 10 units. So you only have 10 left on the shelf. The next week, I'm going to only order 10 more, back up to my par level, what I normally sell per week. And that's going to be financed with the vendor's invoice. They're going to give me an invoice for the 10 that I just ordered, but I'm going to take the customer's money from the first 10 and pay off the invoice. You see what's starting to happen there? I'm making my term loan payment on the first 20, but when I sell 10, I use the customer's money to pay the invoice. And then the rest of it's used to run the business. That's the process, the cycle you want to get into. Because what happens every once in a while is you need more than 20 units. You've got Super Bowl happening, or 4th of July happening, or St. Patty's Day, Cinco de Mayo. Doesn't matter. You need more beer for just a week. Not every week, just a week. This is where you use your seasonal line of credit, your seasonal working capital, or your line of credit. And that's how you finance it, is to buy the additional. In this case, during Super Bowl, we brought in 10 more cases of Budweiser. I used the line of credit to pay for the 10 extra cases. And as soon as the customers bought those cases, I paid off the line of credit. That's what you have to do. In order to make an inventory company work, that's the way you have to use your line of credit. And if you do it right, you only buy it once. And if you have more questions about this, I knew I went through it pretty fast. If you have more questions, contact me and I'll walk you through how this looks in real life as well. Okay. And I use the same thing with my staffing company. I had some with I had a line of credit where I used, first of all, with the first amount of payroll. And then I used my line of credit, seasonal line of credit, for when the hotel's staffing occupancies went up and down, I could still make payroll. It's just as soon as Marriott paid me, I paid the line of credit. Okay. All right. So what do we do next? Kind of what are the next steps? Here's what I'd like you to do now that we're coming up on the hour is, hey, go to trulyfinancial.com and check it out. Open up an account, try it for yourself. I can help you. So International does truly provide bank accounts in other countries. We got several countries right now that you can get. You can get a Canadian dollar account, you can get the British pound account, those type of things. If you got a bunch of other ones, contact me offline. And my email address is mike@trulyfinancial.com. Should be pretty easy. Mike@trulyfinancial.com. I'm more than willing to walk through every individual case. And right now, Truly is not making loans. We're building up our deposit base so we can add lending in the future. If you guys know about banks, a lot of times there's restrictions on how much you can lend or when you can lend. So we're building up our deposit base right now to be able to offer that. But we do have relationships with folks where we can talk you through loan products and walk you through that. More than happy to do that. So here is the last keyword today. And it is international, last keyword. All right. So, Gary, you gave me an hour. I used the whole thing, man. But I want to thank everybody for coming. Hopefully you learned a couple things. One about, one is about like debt to equity ratio, how to use it. The other would be about the speed of cash and the cash conversion cycle. And learning how to structure debt. And then, of course, man, I tell you, Truly Financial is really focused on small business banking. If for anything, get it for the cash back on regular purchases. So thank you very much, Gary. I appreciate the time.
Absolutely, Mike. Thank you. Thanks for sharing your knowledge. And I have to say, as you're going through all the ratios and what have you, I was having some flashbacks, not necessarily good flashbacks, but that is great information. But actually, really, as you were going through all that, what I really thought was, wow, you and I need to figure out a way to teach chunks of this on a regular basis.
Yeah, probably a little slower, walking through a little slower, a little bit more.
Just where you can dive a little bit deeper into kind of the whys or the whats on, those key areas, right? And it's kind of endless. What we could talk about or what you could talk about, I would be kind of sitting in the background. So let's talk about that offline. Also, I told Mike, I think it was in email before we got on this, that I did order his books. And so we're going to have a little chat about that. Once I get those books in, they're supposed to be in this afternoon, but so he and I are going to have a chat and then kind of let him share a little bit more about what he's covered in those books as well. So thank you everyone for joining us today. Mike, thank you for sharing your information. And as I mentioned before, you should have the slide deck is in the chat. So download that. It will be sent to you as well. And then the recording will be available on our YouTube page, but that too will be sent to you. The link for the YouTube page will be sent to you. It should be posted probably within a week. And then lastly, you will receive, if you qualify, you'll get the CPE certificate in the mail within email within 24 hours or so. So if you have any questions, you can reach me at info@insightfulaccountant.com. And again, Mike was mike@trulyfinancial.com. Mike, appreciate your time. Everybody who attended, thank you for carving out some time out of your day. Thank you very much.
Everybody.